Thank you, gentlemen and lady, joining for today. I think it's a very important discussion. It's a discussion which is probably for today and for the future as well. I think if you look at it today, the definition of infrastructure itself has changed, right? The traditional way of looking infrastructure and the new way of looking infrastructure has changed. I think that's the important transition we are, and we are living through this age. I mean, I would say I'm very lucky to see this change which is happening today. But I think it's an infrastructure shake-up as well. I think look at renewable energy, the kind of norms coming, ESG is playing a very important role, electricity, mobility. I'm talking about all of these factors playing a very important role, how the infrastructure has to be looked at it. Now, from this lens, investment also looked at it very differently as well. According to you, how is this transformation is introduced to us? And is it creating enough investment opportunity for us? Or what type of opportunity?
And when initially in early 2000s, when infrastructure as an investment class began its journey, it was mainly solid regulated asset-backed utilities, so power assets and certain transport assets. And there has been a significant evolution of infrastructure. So over a period, some of the telecom towers got added, digital infrastructure got added, social infrastructure got added, the hospitals and schools. Look, I think what you mentioned is very important sectors. That's where with all the the net zero commitments and all.
It's a foundation. It's the foundation of any.
Absolutely. So these sectors are very important. They are still at relatively nascent stage, but the infrastructure community, investor community will absolutely embrace them. They are embracing them.
I would say it's not the first time. We may look at it as actually a sector which is actually coming up, new battery charging, etc. But at the same time, if you look at for India, even the traditional infra elsewhere was a new age infrastructure in 2000s. The risk is very different, okay? And the type of investments which were happening at that time was early stage growth infrastructure. That's what the thing which was happening, which is quite different from actually how elsewhere this was understood, okay? And all the sectors which you mentioned, Rahul, just looking back, it made me to actually go back in time. And every sector, the first investment in airport, the first investment in gas pipeline, first investment in telecom tower, I was a part of the team which actually invested in all those things. Yeah. So it was new, it was risky, but we were able to actually take that call, went ahead and actually make that investment. So today, if you look at it, the sectors which you're talking about, okay, it's new. The difference today compared to that time is these sectors are evolving simultaneously in India and elsewhere. So you don't have a playbook, you don't have a rule book, how it has actually played somewhere else. So it's not only that earlier we need to just take only regulatory risk, a little bit execution risk, because finally how it's going to come out and there will be somebody to buy. But today, there is no precedence for us. It's just evolving everywhere else. To that extent, the risk is slightly different.
Nayantara. Actually, so just picking up from what Rahul said, what we are seeing is, traditionally, I've been looking at infrastructure now maybe for about 15 years, and it's always sort of been seen as a stable source of revenue, stable yield. So we've seen sustained interest in the sector. But the kind of subsectors, the kind of projects and avenues that are now attracting interest are very, very different from what it was even 6-7 years ago. And what we find is it's a little bit of both. So it's evolution of certain subsectors that is leading to traditional sectors having to pivot. A very good example of this are things like data centers, right? When data centers are becoming the next big thing, warehousing, data centers, warehouses are primarily being encouraged by the exponential growth in e-commerce. Tier 3 cities, Tier 4 cities are now getting warehouses. Like some Morgan Stanley are investing in warehouses, willing to take on early stage risks. So just to sort of finish up what I was saying, that things like the European Union imposing a carbon tax, this whole carbon border adjustment mechanism is fueling large decarbonization deals in India. I mean, it was in the paper, Sterlite did one of the largest decarbonization deals because they have to remain relevant and competitive in that market. India's government's policy to make fuel less polluting is leading to more ethanol plants coming up, for instance, more CBG plants. So I think a lot of these new sectors that are becoming avenues for growth are being fueled by both policy changes change in our consumption patterns, as I said, things like e-commerce and just other sectors that are also evolving simultaneously?
Data center is a great example. We have got now data center funds as an infrastructure because these are real assets which we can count on. I think the problem is with the investor is still the traditional sector is a very solid base. Install base is very heavy. And the new base is appearing, the new industries and the new companies and all of that is appearing. How do I balance my investment? How do I figure out, I need to pick this asset versus that asset?
I think good news, Shalil, is that there is no shortage of capital. So it's not that they have a finite capital and they have to do traditional versus new.
Yeah.
So I think that's a good news. I think most investors that we speak to, they can do this from their normal infrastructure pool.
Yep.
Because even if it's a fund or it's a proprietary investor like a pension fund or sovereign wealth fund, they can always create a bit of pocket. The managers have that discretion. There are others who have started energy transition fund or climate change fund, dedicated fund. So I think funding is not an issue. I think sometimes there could be two potential challenges. One is the size, because the international investors don't want to invest in too small, because the asset management time is the same. I think there's a recognition that in the nascent sectors they'll have to start small and then add, but size is an issue. It's really not the availability of capital. Secondly, I think there will be where it differs from traditional is the business models are well-trodden paths. People know how to price certain things. Here, as Shyam very validly said, they don't have a reference of their home markets, right? So how do you price that? So I think there will be a bit of, and it will be sort of very specific to each sector.
So the way in which we thought about it, similar to what you said, there are large pool of capital coming in. You have the traditional investors elsewhere, like the pension funds, the sovereign wealth funds, etc. There's coming out a large pool of capital. But that money definitely is going to go first towards the traditional infrastructure where there are operating assets where people are going. But these type of newer sectors, it's really going to be very difficult for them for both the points which you mentioned. One is in terms of ticket size, and second, the stage of investment. So we felt that there is a gap in the market, and that's where we should actually start doing things. And as I mentioned earlier, our experience in terms of investing in any new sectors, being the first entrant, being that space, we thought we'll try to do the same thing again. And the way in which we putting together the portfolio is, if you look at, there are 3-4 themes which are playing. One is decarbonization, then digitization, demographics, and what we call the last one is the responsible consumption, resource efficiency. The way in which we think about is like being the first in that particular space and try to get that extra juice and try to de-risk the model as much as possible, scale it up to a size, and then after that, you manufacture this asset, stabilize it, and give it to the large pension funds.
So Nayantara, this is a great problem which we have to solve, right? Two things I see changing. One is the appetite of a risk, because we don't have the precedent there, how much we should go for. And the second is, are the factors of assessing the traditional infrastructure assets are same versus the factors of assessing the new age infrastructure, or they are changing?
So the factors are certainly not the same. Now, as lawyers, what happens is we have exposure to many different kinds of investors, right? And each investors or category of investors, risk profile, expectation of reward and risk are very different.
Sure.
So when we are advising a pension fund, they look at more mature assets, as Shyam said. But there are PE funds who are willing to take today early stage construction risk. That's also because in the sectors where we see a lot more activity, there aren't as many mature assets or platforms to flip as there were before. There are fewer, and the size of the assets are also not what it used to be. I mean, there are only that many platforms the size of, let's say, a Spring that was sold last year to Shell. Now, while yes, these are also evolving sectors in the West, but they probably have a little bit of a head start over us. What we are seeing in those spaces is India is seen as a great investment avenue for people who have this experience elsewhere. It's also a great investment avenue for traditional utilities, oil and gas players who have the capital to deploy, who have the need to move away from traditional upstream oil and gas, and who have existing networks in India which they can leverage both with the government and in terms of supply chain to be able to do these projects. What we are seeing a little more of as a part of this whole risk management, are lots of joint ventures that are happening between foreign players and Indian domestic players, where the foreign players are contributing technology that they have the experience of doing elsewhere, whether it's offshore wind, whether it's electrolyzers. The Nordics are way ahead when it comes to these kind of things. They are tying up with established Indian business houses who manage risks such as land, permitting, liaising with the government. Exits are very carefully and strategically negotiated, that what happens in case of a regulatory change, what sort of protection are we giving the foreign investors.
But Nayantara, this is also creating a problem, right? Because now I am carrying as an investor 2 countries or 3 countries risk, right? Nordic countries risk and India country risk. It's going to be very difficult for me to.
Well, I wouldn't say so. I mean, also, there's very little Nordic country risk that you actually.
Rahul, what's your? I'm not saying not. It could be China. It could be.
Well, China is a slightly different ballgame, but.
No, I wouldn't say there is any incremental risk. I think you're not taking country risk. Maybe there's a technology risk. I would also like to bring another dimension that I think the discussion we are having is the investors only investing in these sectors.
Correct.
And okay, there is another way where established platforms. So an investor is invested in a traditional infra platform, and through that platform, they're taking a bit of entry into these new sectors in a limited way.
So there's another way we could actually look at in terms of from the risk perspective. Is like, see, if you look at infrastructure, the traditional definition of an infrastructure is you typically have a license or you have a concession agreement, and that's how typically you look at it. But there's another way. The way in which we look at the stuff is slightly different. The way in which we look at it is, as long as there is a predictability of a cash flows, which can come from any different way. It could be like in some situation it's just a license to operate, or it could be a situation where you convert some sort of a capex into an opex model, where you have a medium-term contract, whether it is 3 years, 5 years, or 7 years, and that in essence actually mitigates a part of the risk. And what we also do is, like, whenever we are doing a little bit of an early stage growth, this type of a risk, what we also do is start actually like do some acquisitions, so that you can scale it out. So traditionally in infrastructure, you go on actually like an asset level. Then we did a holding company levels. Then in the holding company, then a little bit of a what we could do is like additionalities we bring in.
Lawyers speak, but risk to an extent gets mitigated by better governance. And I think overall governance standards have certainly improved in India. Partially because of the kind of investors who demand those kind of standards, partially through new investment vehicles. So even if you look at the InvIT, which is becoming such a popular model for holding of assets, the kind of governance standards that an InvIT has to live up to are much higher than regular companies, right? So I think better governance also results in better risk management.
And the disclosure norms which are
Yes,
coming
are
with
much
this, are
more
tightening
stringent
up,
for
and
InvITs.
transparency is being coming up. Now, today, this whole ecosystem is changing so fast that for you to think for a long term is going to be a difficult, but still it is infrastructure. You know, infrastructure used to be the heaven, right, for the investors. Now, today, infrastructure is not going to be heaven for the investor. They need to monitor more and more, if you look at it. Is this going to bring a sea change, or is it still just the temporary phase? Guys, we'll get to there as the outlook from investor is going to be long term only.
No, I think it's a temporary phase. I think, as Shyam mentioned in another context, is that it gives an opportunity for some of the investors, presumably more asset managers rather than proprietary investors, to fill in that void where there is not set business frameworks, no regulatory framework. Navigate through that, build business up to a scale, and then when there is a more clarity for a low risk investors, that gives an opening. Even the proprietary investors we see are creating a small pocket to say, okay, we ourselves can take a little bit of more risk, because it's the cause for which the climate change is now very central to everyone's investment themes. So I think from both perspectives, I'm not seeing that as a challenge. Obviously, that will mean a little higher cost of equity to compensate for that risk.
Yeah.
I think the financial sponsors will find it difficult in order to take the technology risk, because that I think is going to be a challenging one.
Yeah.
And that's where
That changes very fast.
That changes very fast. So it's very difficult for people to actually assess that. And I don't think that not too many people, that has to come from a strategic investor or someone, as you said, guys, the corporates elsewhere in the world who actually done some initial learnings of the technology can come to bring it the same thing to India. Yeah. what the funds can do, they can take the business model risk.
But you're advising so many customers today, right? And most, as like, this is the noise of the world today, electric vehicle, mobility, digitization. How do you fund a drone project? I mean, think about it, right? It's not going to be easy. There are no laws there. There are legal frameworks to be created. I mean, I think the legal firms has to think ahead than actually investors has to think about. Because they will come to you only for resolution.
I do think that one of the key challenges is the fact that our regulations don't often keep pace, and not just don't often keep pace, the state and center dichotomy makes it even more difficult in sectors where both have the power to legislate. Even simple things like how funds participate in bids, right? If you look at the way bidders are defined, way net worth is defined, way transfer restrictions work, nobody holds a fund. Like the fund will not hold an investment for 14 years, 15 years. They'll flip it. So you have to allow that. You have to allow affiliates definition to include things like that, where you have platforms managed by the same investment managers.
But it's an honor taking time out for busy schedule for being with us today and having insightful discussion, very detailed, drilling it down on this one is thank you very much.